We're going to take this opportunity to do a deeper dive with Daniel and Joe on the financing markets, and hopefully lots of good advice for the folks on the line today. So Joe and I have the pleasure to spend all of our time pretty much in the British Columbia tech ecosystem. And Daniel certainly spends a lot of his time here as well. We get the pleasure of him coming out regularly. Something he lives here. And so he has a good familiarity with the diverse number of tech companies in British Columbia. So if each of you could take us through what you are excited about in this tech ecosystem from an investment standpoint, and maybe I'll start with you, Joe.
Well, I think one of the things I'm excited about is when I was doing venture capital many years ago, I mean, a lot of my companies would have been really stuck right now. They were pre-revenue. It would be a tougher environment, to sell a first-time company into enterprises, aren't really taking tons of risk right now. But at the scale that a lot of our clients are at right now, and I would say, early stage sort of being sub 5 million in revenue, companies do have a little more optionality. They are, striving to get to profitability. They're striving to reintroduce, expansion inside of their existing customer base, and better controls around spend. And folks are really looking at data in a way that they hadn't looked at, prior. Are they getting a return for this conference or for this trip or for this, whatever it is? And I think that companies that survive the next, year or two are really going to benefit from having, gotten a whole lot more rigorous in their approach to, how they conduct business. So I think after every, ridiculous bubble of free money comes a period of pain and, an introspection that ultimately drives, the economy to produce better companies. So I think it's necessary, and it's I don't know, I wouldn't necessarily say we should embrace it, but I mean, that's the reality we're in, and we are going to embrace it or die not embracing it. So anyways, I think it's a healthy and normal part of the fluctuation of the processes of the pendulum moving from one end to the other.
Yeah, absolutely. And Joe, you've been in this industry a long time. So you've been
I'm just looking at the screen. I have been in this industry a goddamn long time. Like I'm looking a lot older than I want to.
Oh, I wasn't saying it from that perspective. But you've seen a lot of cycles, and you know how that companies come out the other side. So reassuring to those on the line. Daniel, capitalizing on what Joe was just talking about, and as well, you touched upon efficient growth. There's a question in the chat that says, can you explain a bit more what efficient growth looks like? Is this in the context of being profitable or not necessarily? That would be really helpful for the group.
Sure, absolutely. In public markets, I think the key is profitability to some extent. However, in private markets, it's not necessary. And so, if you're growing at 60%, but you're burning, your free cash flow margins are negative 20%, you meet the rule of 40, and that would be efficient growth. However, you'd want to dig down into the unit economics as well. And so it's not just that overall top and bottom line combination, but how effective are you with your cost of customer acquisition? How quickly can you break even on it? And then how well do you retain customers? Because ultimately, how well you retain customers is going to be a key input in the lifetime value of that customer. And so as long as your lifetime value to customer acquisition cost is greater than 3, and you can manage within the rule of 40, I'd consider you fairly capital efficient.
Yeah, and more of the private equity firms and VC firms I talk to are really talking about, they don't even necessarily looking at it, the lifetime value of a customer. They just look at, you better be spending less than $1 to bring on $1 of revenue. And that's, ARR based sort of mathematics. But if you're spending $3 or $4 to bring on $1 of revenue, you're basically unfundable in today's market. And the VCs have gotten very tough on that. Whereas, as Daniel points out, 2 years ago, that was not a metric that folks worried about. It truly was grow at all cost mathematics. And it was, things have changed.
Yeah, absolutely. It's very much a risk-off environment, whether you're in the private capital raising, the public markets, or M&A markets. You know, there's that overall lens on it is risk off. And from a public market perspective, I would say that transition into EBITDA positive is exceptionally important. And we have seen a number of companies from that IPO class that just happened that have made that transition and have been rewarded in the public markets with a sigh of relief by their investors that they were able to make that transition in a really effective way. And it's not, as Joe said, it's not easy, it's hard. So the other key question that I think folks will benefit from is the extension of runway. And as we know, valuations have come down, and so companies are trying to extend their runway. What are some things that you're seeing from your perspective on how companies are doing so? Want to start, Daniel, on that one?
Sure, I can start. One way to extend runway and raise a bunch of capital in this market, put .ai at the end of your company name.
Okay, real way.
But failing that, if that's too disingenuous, I think A+ companies who meet the Rule of 40 and beyond with very strong unit economics, they're not having any trouble attracting capital on clean terms in the market. Unfortunately, not all companies are A+ companies at all times in their evolutions. And that's really important, at all times in their evolutions. Because the path to a category leader is almost never a smooth path upwards and to the right, and will almost inevitably have big ups and downs along the way. The challenge in the funding market right now is in those companies that are not A+ companies, who are not A+ companies right now today. They may have been a year ago, they may be next year, but they aren't today. And so in these situations, investors are really quite reticent to bear much risk with these companies. And so one tool that's been relied on more and more in this market is to come up with some creative deal structuring to reduce the risk that investors take on against their return. And so, this is where structured equity comes in. It effectively allows investors to bake in return so that they can take on some valuation risk as a trade-off. Now, it's not appropriate for every situation, especially if you expect to have to raise more rounds. And it can create some misalignment for shareholders in the existing cap table. But it can work if you raise enough for this to be the final round of money that you raise.
So yeah, looking down another level at the more operational level is I've seen a number of companies sort of, reach out to me with the following story is, we're facing significant headwinds. We're looking at tabling at least, a narrative on cash flow break even, sometime in the future, and we're starting to lock down plans to getting there. We've, upgraded our board with a little more operational talent, with a little more CEO mentoring capability, perhaps someone who's been through a couple of cycles before, maybe some gray hair, no hair on the board. We're talking to our investors about, what their capacity is to bridge us. Once we table the cash flow break even plan, can we get there on the existing, gas in the tank? Can we get there on gas we may have access to from the cap table as it exists today? And then, if there is a bridge to be done, it's a great time to work with your bank and say, hey, listen, if the investors come forward, with X amount of money, could you guys, give us access to some credit facility of Y amount of money, that gets us to Z? And so I think, some companies gone through a proactive RIF of some nature after growing really fast, maybe in 19, 20, 21. Maybe their expense structure is just a little bit out past where they want to be. And I think sort of bringing a lot of these elements to bear at one time and working, with the network around your company is maybe going to, help you, table a plan that has, sort of multi-party support that can get you, from here to there. It's super tough. I'm not recommending a RIF, but most of my companies have done one at this point. And I'm certainly not recommending, bringing people onto your board willy-nilly. It's a very careful process, but it is good to have some experience up there from folks that have maybe been through a couple of cycles and just know what to do, or can reassure you that you're doing the right thing. There's lots you can do even in a down cycle, and it'll certainly pay dividends in the long run in any cycle. But anyways, yeah, lots to be done right now, and a lot of my best companies are like way ahead of this, as they get ready to get more efficient.
Yeah, that's great. And Joe, I agree with you, like that all of the stakeholders, have them around the table and make sure that you're really working with all of them.
Well,
The
and
other one talked about
it's so
is
easy for someone to say yes when they know other people. Like, if you're getting a
Yeah.
small check from your equity investors, that support, it might refresh your EV, it might be unpriced, but it certainly gets, it helps the bank move their processes forward. It certainly gets, a new director excited about joining. Like that, there's just so much that can be done if if you start moving the levers.
Yeah, exactly. And the other one I took away from that is start that work early and don't surprise. Because nobody wants to be under the gun in a tight time frame. And so make sure that it's well communicated, well documented, and you're giving advanced preview on things so that you don't surprise any of your stakeholders.
Yeah, so true. There's nothing that grinds the bank to a halt like a surprise. It is very hard for us to move things through the process if we're getting surprised.
Yeah, absolutely. There's a couple of questions in here around AI, no surprise. We'll talk about the first one, which is there is a lot of talk about infrastructure investments around the models for AI. But the other one, and I agree, is those real world situations. How do you take it from concept and big picture into real world situations? And are we seeing this now? Is the venture money starting to get smarter and demanding those real world solutions? Where are we at in that cycle in the AI world?
I think the money's largely pouring into infrastructure at this point because that's what people are trying to figure out. I think when it comes to the application layer, so real world applications of this Gen AI stuff, there were a lot of people leveraging the OpenAI tool set, just putting a wrapper on it and effectively creating native AI applications that were really more a feature than anything else. And really, I think to differentiate in that application layer, the moats are very similar to what you've got in the SaaS world. It's, you need to be able to deliver workflow advantages, really narrow down that ideal customer profile and deliver true value prop just across the entire spectrum, and not just with like a really cool redlining feature for contracts or anything like that that's generative AI enabled.
Mm-hmm.
Yeah, I mean, everyone's adopting for sure. Like across the tech ecosystem is, I'm sure there's a project on at every company to identify areas where AI, is ready for prime time and can be implemented, and be, sourcing, the best and, the best sources of that functionality for the company. I have not run into a tech company that is not, pretty far down the curb and thinking about how AI affects, what it is they're trying to accomplish.
Yeah.
But it's early. Like, I don't know. When I think of AI, sometimes I go back to the start, like, there was rules-based and then constraint-based and then fuzzy logic and then, what have you. I mean, the current set of AI instructions is so much more pervasive, but tech companies have been adopting AI for 20 years, in the best form they could, whether it's in the customer service, the response, whatever it is. And so I expect that trend is going to accelerate dramatically, in the next couple of years.
I'd say at the enterprise, there's still a lot of work that needs to be done from the data sort of ethics and data governance, data security side before it actually gets truly adopted. Too much of the data that you need to train the models required for real life enterprise applications, it's difficult to get to. They sit in different silos and it's really difficult to get it out of those silos and into a production a production app.
Well, and it's so cool what's going on at the regulatory layer too, right? Like in the US, it is, we're seeing some breaks being forced on companies, and We're seeing companies with massive data sets, you know, that have a significant advantage on, you know, training these AI bots and applicate it feels so early stage, doesn't it, Daniel? Like even the rules aren't set yet.
Yeah.
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 For sure. And then, of course, yesterday was dramatic.
Oh,
Or even
yeah.
the weekend.
Yeah, I was gonna say, one of your slides is already out of date. Like,
I know.
you must have done it yesterday morning.
Exactly. So, and there's a question, I'm not surprised. Are there, and maybe we take it from, I mean, there's tons of repercussions from the recent management change at OpenAI and the shift over to Microsoft. So lots and lots of industry changes. I don't think we're necessarily the ones to weigh in on that. I'm listening to a ton of podcasts, but when you think about it from a financing point of view, from an M&A point of view, like what's left, what happened to that shareholder value, that could be something that's of interest to the folks on the line today.
Yeah, I listened to the All In podcast, guys, on my walk home last night, and they weighed in on it. But I mean, they were trying to wade through the complexity of, you know, the corporate structure, and you know, you know, on one side there's a complex web of shareholders, on the other side there's Microsoft, who supplies the money, and even I wouldn't even begin to be able to comment on something that those guys, you know, were having struggles, you know, figuring out. It's a heck of a listen. Obviously, it's a lot of people are writing about it today. My inbox was full this morning from people recommending I read this, that, or the other
I think there's a good article on the Stratechery board that I've got on my to-read list, but I haven't gotten to it yet.
Yeah, but from a financing perspective, I guess it does take you back to the value of those people and what they've created, and can people just walk out the door? Like I think
Totally.
that's going to create the nervousness in an investment environment, right? And I remember doing a fairness opinion. It was a dollar value paid per engineer, because back in the day, in you know that 1998, 1999, to get that talent was just so tough. And so even pre-revenue companies where we didn't have any valuation metric, I remember, and it really took our fairness opinion committee. They're like, what are we doing now? What we were doing enterprise value per engineer as a valuation multiple, right? And you think about those people that walked out the door, valuable.
You look at what Databricks did, right? When they bought Mosaic ML, which didn't have much in the way of revenue. They paid effectively $21 million per engineer.
Yeah, exactly.
It's back.
Exactly. Yeah. So in those instances in which that talent is very highly valued.
And it really highlights, like, you know, how adept you've got to be when you're, you know, living in a world where so much of it is open source. It's you know, I just find it's a game where you better have folks at your table that really know what they're doing.
Yeah, agreed. There's another question here that kind of capitalizes on one I was going to ask you as well, which is, when does this tip over? Like we've kind of come through, valuations have settled in the public market. Certainly they've come and settled in the private, definitely late stage, but even getting into the VC side of things. And it seems like the US is ahead of us, as is typical, on investors starting to write more checks. When does this tip over? And do we think that the US market is ahead of us from starting to write those checks in a more deliberate way, whether it's venture capital, late stage? I can comment on public. No, IPO market's still very quiet, but M&A, you know, what's the view on that from an environment perspective?
All right, so here's what I think is, I think we still got some pain to work through here. I think when public markets are off, what happens in some of the, you know, to some of the fund-to-fund folks, some of the endowment folks, is your public values go down, they contract. It sets your private portfolio, it all of a sudden looks overweight, and it's tough to get more allocation for that portfolio. So, you know, it takes time. It just takes time. People are off their treasury mandates. You know, like they are over allocated to private equity right now. Bill Gurley wrote a lot on this phenomenon, and, you know, and his predictions turned out to be, you know, more or less bang on. Is it looks like, VCs are sitting on their hands a bit, and they are. They're deciding where to allocate their remaining resources in this current fund. But I think raising the next fund is going to take just a little bit longer. There's going to be a lag, I think, in that activity, and I think that's going to last us, for a couple of years. I think things are going to slow down and take a couple of years to just work through the system, and then the public markets will recover, money will start flowing out again. I know there's still tons sitting in money markets. There's piles and piles of money on the sidelines. But I think from the VC perspective, there'll just be a slow year or two in terms of closing new funds, and then things hopefully will return to normal.
I think it is the public markets that need to recover first. And I don't have a crystal ball on this, but one of two things needs to happen. Either inflation goes down and rates move down with it. Or if the rates stay higher for longer narrative rules today, then companies need to outgrow the new cost of capital through either greater top line growth or earnings growth. And a number of economists have actually cited Gen AI as potentially an underpinning of why markets haven't fallen as much as they probably should have, given the rise in the cost of capital. But we're still in the early days of adoption in proving that all out. And then the question about BC companies entering getting more attention from US investors, I don't think that's an issue. I think the US investors look at BC or Canada in general as like the 51st state. I don't think there's any borders here.
So I couldn't agree with you more there. Is I have seen so much activity, and it's not the Valley VCs, VCs coming up here more, but I find the East Coast VCs are here all the time. The JMIs are here all the time. The Norwest, the Insights, the Frontiers, those folks are calling on us very much, like as Daniel says, like the 51st state. Like those folks are coming to town, and part of it is, there's a lot of LP activity from the Canadian funds, including, from the banks. So CIBC's, has put $500 million of LP action out there into the US funds. And part of the deal there was, for them to come to Canada and have a look around. And so I think the border is definitely open. A whole bunch of funds 10 years ago, 20 years ago, were doing their first deal up here, and it was hard. Like it's a different regulatory environment, it's a different legal framework. But once you've done one, and they've all done one by now, it's a lot easier, and they're here regularly. So if you fit their theme and their stage, which is usually a little bit later on, you've got every chance of closing on as much chance of closing on US money as anyone else. And they don't need a Canadian VC to underpin the deal anymore. You can raise your first round from a US VC nowadays.
Yeah. That's great. And so talking specifically about financing, what are the top 3 things that you would say investors are looking for in today's market? Daniel?
So, and this is from a later stage perspective, less early stage, but from that perspective, I think it comes down to a realistic path to profitability, and at the very least, profitable unit economics. It was this Reid Hoffman from Greylock, not Benchmark, who's the founder of LinkedIn. He popularized this blitzscaling approach to company building a little while back, based on his own experience with PayPal and LinkedIn, really. And for those of you who aren't familiar with the term blitzscaling, it's when you prioritize speed over efficiency while pursuing rapid and massive scale to become the dominant player. The way that he describes it is like it's like jumping off a cliff and then trying to build an airplane while you're falling. Yeah. And so the goal is gain market share, forget about unit economics, figure out how to make money later. If you need to sell, if you need to sell dollar bills for 70 cents, do it, because you'll make money later. And so this worked well when money was essentially free. But now that money is becoming more scarce and expensive, it's no longer the case. And investors absolutely do want to see that if you had to become profitable, that you have a tangible and realistic path to getting there.
Yeah, I certainly echo that. I've sat in meetings with, a lot of VCs over the course of the last couple of months. And they're all saying the same thing. They're all saying not even rule of 40. Like some of them are saying rule of 70, like they have their own rule of.
Yeah,
They're
some
all
bars have gone higher.
Yeah, some bars have gotten higher. And that doesn't mean low growth and high gross margin. It typically means high efficient growth is what they're getting at there. And
Yeah.
they all talk about it. They all use the words Daniel just used, which is great or superb or superlative unit economics. Unit economics is becoming a thing where I think what they're saying is you really have data around how and how you sell and what it costs, and you really understand it. And you don't think of a sale as a single point of data. You think of a sale as 70 points of data, and you really understand what those levers mean in terms of marketing spend and cost of acquisition. Like those are and tech companies are in general really good at this stuff, right? So it's a great play. It creates a very common language that the companies and the investors can speak together. But more and more the investors have internal groups that are experts on this. They're SEO experts, and they're sales economics experts. They're analysts working inside these funds that really integrate with the company, the target, and really get to the baseline of what can be optimized, what can be improved. Part of their investment thesis is very operational and deep. And I don't know, companies that enjoy that process really thrive in front of their VCs, and companies that are not as well versed on on their own operational challenges really get stuck. And so the companies that are great at that are it can really set themselves up as tier one targets for venture capital.
Yeah,
And just
absolutely.
relate. Oh, sorry.
Yeah, sorry. I was going to say, Joe, that leads me to a question I was going to ask Daniel, because I've had the pleasure of working with Daniel for many years now and see him in action when he gets hired to sell a business or raise capital for that business. And what he does is the prep, like the prep. And so that investment thesis and all those analytics that they're going to dive into, he's already done and helped and scrubbed and etc. So Daniel, do you want to share any gotchas or things to make sure you're on top of for the audience today so that they are in a good position?
Sure, absolutely. And thank you for the kind advertisement, Kathy. Ultimately, with this sort of stuff, particularly when it comes to unit economics and really defining the ICP and the TAM and all that other good stuff, it really comes down to how solid your data is. And a lot of the time, what we see is companies have different data across different sources, and there's no real one single source of truth, right? They might have a bunch of their accounting entries in QuickBooks or Sage, but then they'd have a bunch of their go-to-market statistics mixed up between Salesforce and then the invoices that they send through, which whatever invoicing provider they use. And then they might have a bunch of, the marketing data in something else. And so, when you're trying to tell a story, a data-driven story about the top of the funnel, unit economics, and how it all boils down to the baseline set of financials and how those underpinning assumptions can drive a forward number that you can buy into. It's really important that you've got that one single source of truth and that all of the data is consistent. And it's really it's not fun work to do. And when you're growing and you're funded, a lot of the time these things tend to get overlooked. But data hygiene, I think, is be the one thing that I put out there as something that's very critical.
Yeah, absolutely. And whether that's for your management decisions, your board reporting, your bank, making sure your bank is comfortable, and then through to your shareholders, they're all extremely important. Erica, I
was just going to add to that same list is, oh my goodness, have your share registry. Like, it should be up to speed, your employment contracts. Like, there's a whole bunch of things you can control with just a little bit of work with, whoever you're using for legal counsel. And hopefully you're using someone from legal counsel that knows what they're doing in tech. There's a couple of awesome lawyers here in Vancouver I strongly encourage, folks to start with one of those, and like not Uncle Ned's friend who also does law. There's just a lot of ways to mature your company, that are entirely within your own control. If you're raising a significant amount of equity, you're going to end up doing a quality of earnings or, a review. If you've been thinking about doing one of those, you might, want to see that through. It's just one more box that gets ticked. Now, I understand you may be looking at every dollar and not wanting to spend it there, and so don't. But anyways, like there's so much that can be done, getting ready to raise capital.
So Joe, big prediction for 2024. What do you think?
I just think that, the companies that are the best operators are going to come through this, just fine. But it's I have no massive predictions. I think it's going to be a fairly homogeneously marginal 2024 in the finance world.
Okay, Daniel, a little bit of ray of optimism, please.
Well, I'm hopeful for the return of the IPO market in Q2 of 2024.
Q2?
It has to happen then. If it doesn't, it's not going to happen because it's an election year. I know some of the IPOs that have been out there right now, like ARM, Klaviyo, and Instacart, haven't performed, but there's a queue of some really high quality ones, and I hope the window exists for them to go public and perform well, because then that could potentially open the floodgates for the rest of the companies, which then could feed into a return of the VC market.
Yeah, and that comment came through on in the chat as well. The US election playing a very disruptive role. And I absolutely agree with you as we kind of think about mapping out the year from a public markets perspective, where I generally spend a lot of my time. That's very much in the foreground of how we think about advice on the go forward.
Well, we have just 1 or 2 more minutes. I do always like to ask our guest speakers one final question as we close out the session. So I'm going to take a chance to fire a question at the 3 of you. As you know, we have lots of our startup members on the line who are starting out and have big ambitions. Would you guys share maybe just a final piece of advice or words of wisdom with them as we close out the call? Maybe Joe, I'll come to you first. You're nodding, so you've got something to say.
Yeah, no, well, I mean, it's the same in every cycle. Is just make sure your customers are delighted with you. Like if your customers love you, you can raise capital. I feel, if and I think it's also good to keep them aware of, they may get a call, from someone who is, doing some due diligence on you. And, I think that really it's the message we're getting, by the way, from the higher ups in the bank, like, get close to your customers. Like we're when markets are difficult, be with your customers.
Excellent. Daniel.
I'd say, some of the most successful companies ever created were created in an environment just like this. Where capital was difficult to raise and the overall macro picture didn't look great. And so my advice would be, don't give up.
Perfect. That's great. And I know we had Jack Newton of Clio on our last session, they started in 2007, 2008. So they were in the last down cycle. Kathy, over to you. Piece of advice.
Yeah, Clio is a perfect example. They really, and they delighted their customers, to Joe's point, by focusing in on specific customers and really making sure that they had the solution for them. I would say for me is don't take too long to make those tough decisions. If they are apparent to you, whether that is a trimming of the team or a changing of the business model that's not working from a revenue perspective, driving that efficiency in your metrics, like just don't take too long because time could run out. And I think bold decisions are going to be really important in this environment.
Excellent. Well, appreciate all of your input in such an excellent session. I definitely will take away, it's good to lean into your network, reach out to people like the folks at CIBC to help you on your way, and also to learn from others, learn from other BC companies who walked this path before. And you could do that through many of BC Tech's programs like our Seed Councils. Thank you to our audience for such an engaging interaction in the chat. you.